Good morning. My name is Greg Upton. I'm Associate Research Professor here at LSU Center for Energy Studies. Welcome to our 2023 Gulf Coast Energy Outlook Kickoff. We especially welcome those of you who might not be familiar with the Center for Energy Studies, or CES as we call it. CES is a unique research unit at LSU, and that we were actually created by the legislature in 1982. And we're mandated to provide energy information and analysis that responds to the needs of the legislature, public agencies, business and civic groups, as well as the general public. The annual Gulf Coast Energy Outlook is one way that we fulfill this mandate. The majority of our funding comes from the legislature through LSU, and we also participate in funded research through federal and state agencies, as well as private companies. We pride ourselves in our diverse constituency and funding sources, which allow us to provide analysis without a political or economic agenda. We especially thank the sponsors of this year's Outlook from across the energy value chain. That includes Phillips 66 at the platinum level. At the silver level, we have Entergy, Enverus, Koch, the Louisiana Oil and Gas Association, and Placid Refinery. At the bronze level, we have the Southwestern Electric Power Company, Louisiana Department of Natural Resources, and Louisiana Economic Development, Postal Wait and Netterville, and the TJC Group. And at the contributor level, we have LOG, LOX, and the Southwest Contractors Association. So please provide your support for these organizations who contribute to the Louisiana and Gulf Coast economy. And if your organization's not on the list, we of course welcome you to become a sponsor for next year's Outlook. I'd also like to thank the dozens of individuals that David and I have talked to, not only this fall, but throughout the year, from industry, government, trade organizations, and academics that have spent their valuable time speaking to us in preparation for the Outlook. While of course there's crunching the numbers and modeling involved in this exercise, and that's of course very important, but equally as important is talking to you who's actually in the field working. And so this input is extremely valuable. It simply wouldn't be possible without you, so thank you. A brief agenda for today. So I'm going to start off with discussing the uncertainties and modeling assumptions that we're going to use in the Outlook, kind of like our base case assumptions. I'm going to then move into the different parts of the value chain. So I'll start off with oil and gas production and then midstream constraints. We'll then switch over to our executive director, Dr. David Dismukes, who's here with me. And he's going to talk about the power sector, energy exports, and then energy manufacturing activity that's happening in the region. And then we're going to switch back over to me to present the employment forecast, which is kind of a synthesis of all this prior analysis. And then we'll switch back to David for some concluding remarks. If you have any questions, please type them on the Q&A on Zoom, and we'll leave time at the end. At least we'll try our best to leave time at the end for answers. You can type those questions, of course, as any time as they come out through the presentation. As you do consider asking questions, please keep in mind that this webinar is recorded and it'll be posted online afterward. And the Outlook itself is now on the center's website, as well as in the Q&A feature on Zoom. Feel free to share it. It's freely available. So let's start with uncertainties, the introduction and uncertainties. So, really how this process works is when we talk to the dozens of people, almost 100 people, I think, this year, I really take notes and I ask them, I say, first of all, well, how's business going? What's currently going on? But also, what is the uncertainties you see in the future that are risks, and also the opportunities that you see? And I kind of bucket these into a few categories. And what's interesting for me is to see kind of how these change over time. Of course, some of the categories persist from year to year, and some change, sometimes quite dramatically. And so this year, there's really 5 of these buckets. First, you have inflationary pressure and economic performance. You also have the Russian invasion of Ukraine that we're going to talk about. Of course, has had just enormous implications for energy markets. We'll talk about supply chain constraints. This is still definitely something that's front and center today. Then we're going to talk about decarbonization goals. And finally, the 5th item we'll talk about is, has uncertainty been resolved in terms of offshore leasing? So let's begin with inflationary pressure and economic performance. So this shows U.S. employment over time. And so as you can see here, you can see like the 2001 recession there. Then, of course, you see the financial crisis in 2009. And then you see this decade-long growth where, the U.S. economy, employment just continued to increase from year to year. And then, of course, you have the precipitous drop associated with the pandemic. This was really a recession like no other recession we've ever viewed before, and just the immediacy of it. Of course, in prior recessions, you kind of had this up and down, this rolling kind of pattern there, but this was really, really stark. What also made the pandemic interesting relative to last recessions is the lag in which we knew the recession was occurring. If you go back to the financial crisis, for instance, in the early months and even year of the financial crisis, the labor market data was actually not looking that bad. It was looking, hey, maybe we're not in a recession. But it was when those revisions came out afterwards that we really saw, the truth of what the recession was. And so the pandemic was very, very different in that it was immediate. We kind of knew immediately that we were in that recession, and government, of course, responded with fiscal policy actions, et cetera. Today, we have reached our pre-pandemic employment, at least that's the estimate right now, as of August, and in October, about 0.5% above pre-pandemic employment. So the question for us today is, are we just, going to continue growing out of this, in the next years to come? Or is there discussion of this kind of recession looming, in particular because of the inflationary pressure? So a few kind of stylized facts. The U.S. is currently at what economists would refer to as quote unquote full employment. The kind of rule of thumb we think we teach in our principles classes is, if unemployment rates are below about 5%, that might be considered kind of full employment. Today, they're below that 4%. Also, the U.S. employment has surpassed that pre-pandemic peak. What's also notable is that the labor force participation rate, an employment to population ratio today is still below that pre-pandemic peak. One kind of way to think about that is maybe people retired early with the pandemic. Other people might have substituted out of the labor market, and maybe they're slow to return, or maybe they won't return. You have dual income households that someone says, hey, I'm gonna stay home at this point and raise the kids or whatever it might be. And so, although employment has rebounded, we might have seen this permanent kind of behavioral response that maybe we don't reach the pre-pandemic trajectory of employment that we perhaps might have reached if it wasn't for the pandemic. And then, of course, the third big thing to consider here is inflation, which has reared its head for the first time in decades. And what we've seen over the last year, of course, inflation is starting to slow a bit, which is good news. But over the past year, we've seen that inflation has actually outpaced wage growth in the U.S. economy. And so with high commodity prices, currently, as we'll talk about here in a minute, really the question for us as we do our employment forecast in particular is, are there enough workers to fulfill the growing global demand for energy products that we're going to see? Or on the other hand, is perhaps a recession on the horizon leading to a demand reduction that will also kind of alleviate some of these supply chain constraints. And so whether we kind of hit what is referred to as a soft landing, or perhaps if we enter into a recession, of course, would input what our outlook is. So let's talk about the demand side of the equation, which is energy growth. And in particular here, I'm looking just within the US. And what you can see, if you look at gasoline and electricity sales over the past decade, they haven't really changed. These are seasonally adjusted numbers. These are not indexed to the population or the employment. This is just total sales here. And what you see is that, that energy demand in the United States has been really steady. And the reason for that is really energy efficiency. As people get new appliances, people get new vehicles. Those new vehicles and new appliances are going to be more fuel efficient, more energy efficient than the vehicles before and appliances before. And so what we see is that, really the energy demand growth that we're looking at is not coming here domestically. It's really going to be coming from those international markets that we're going to talk about here in a little bit more detail. And as you can see, electricity sales and diesel sales are actually back to pre-pandemic levels, but gasoline sales and jet fuel sales are not back to those pre-pandemic levels. And perhaps due to behavioral responses, the demand for these is permanently impacted here domestically. So that's going to be something interesting to watch. So what is our modeling assumption? Well, we're going to assume that the inflation begins to slow and regional economic activity will gradually expand over the forecast horizon. Much like in prior years, we anticipate that long-run energy demand growth will lead to increase in U.S. energy exports, especially to that growing developing world. We don't view energy demand growth as really happening here in the United States. We really view that developing world growing, and that is what we're really watching in terms of what's happening to the supply of those products here in our region. Okay. The second huge uncertainty from this last year was the Russian invasion of Ukraine. We had this timeline, within the outlook itself. So in early February, Brent crude was about $97 a barrel, and TTF, which is of course the Dutch natural gas, which is the major European natural gas market, was about $37 an MCF. So these were relatively high prices, but futures markets were actually anticipating that prices were going to go down. They were in backwardation, both here in the U.S. as well as internationally. But of course, that all changed in late February, when Russia launched its military invasion of the Ukraine. Germany suspended certification of the Nord Stream 2 pipeline that was anticipated to begin shipping natural gas in coming months. And as a result, in March of 2022, of course, this year, Brent crude surpassed $117 a barrel, and TTF surpassed that $45 an MCF. So this, of course, put upward pressure on prices that was not built into those futures markets forecast. And so now, of course, Gazprom has announced that Nord Stream 1 will be shut down due to maintenance, and citing these Western sanctions, and worries mount over Europe's natural gas availability as we enter into the winter months here. So what has happened? What has that done to commodity prices? And so for this, we pull the futures markets kind of in February, the beginning of February, before the Russia invasion of Ukraine. You could argue that maybe a little bit of this risk was built in, but certainly not all of it, in my opinion. And then we look at the most recent futures markets curve here that we pulled in the last week or so. And what you can see here is kind of interesting, is that in the long run, this Russian invasion of Ukraine has not seemed to impact the market for crude oil. Of course, it puts upward pressure on prices, immediately and over the next few years. But in the long run, markets still think that oil is going to be trading in the long run at $55 a barrel, something in that range. But this has kind of permanently shifted up natural gas futures prices. And I think, as David's going to talk a little bit about more, there was kind of this question in the last few years of how much LNG export capacity was the U.S. going to build. How much LNG does the world need? And I think that there will be projects that move forward, LNG export projects, that perhaps would not have moved forward if it wasn't for this geopolitical crisis. And that will further tie U.S. natural gas prices to the global price, which will likely put upward pressure on natural gas prices, relative, of course, to the counterfactual if this event had not occurred. Okay. So this year's GCEO modeling will assume that the war in Ukraine continues, as does Western economic sanctions on Russia. The ongoing nature of the conflict, of course, was going to force global supply chains to adjust, which are already happening. Crude oil prices will gradually attenuate over the next several years, while Gulf Coast natural gas prices will likely remain elevated relative to the post-2008 historical trends due to these LNG export pressures. Now let's talk about our third uncertainty, which is supply chain constraints. So really, people were talking about supply chain constraints before the invasion of Ukraine, and they were talking about supply chain constraints before the economic recovery. But this year, there's really been four sources of supply chain constraints that it's really difficult to disentangle the relative importance, but all of these I think are important. The first, of course, is the economic recovery from COVID. And so there's still constraints associated with that. The second is, the full employment within the economy alongside all of this economic stimulus. And so if you think about just an economic model, what we teach in our principles classes is you have capital and you have labor, and capital and labor come together in order to produce output. And the economic logic for implementing stimulus spending during a recession is that capital and labor resources are not being utilized. So you might have some capital and labor that's in the economy that's not being utilized. Perhaps you can use government spending in order to utilize that capital and labor, which of course can create economic gains. And in particular, if you're going to invest in things like infrastructure that you want to build anyway, that could be an actual good time to do that. But what we've seen is this enormous amount of stimulus that I'll talk about next, in particular with the IIJA and the IRA, that a lot of this is geared at the energy sector in a time where we're already at full employment. And so what does economic theory suggest? It suggests that, well, output, in those sectors, if it's going to increase, the way it's going to increase is by driving up prices. And that increase in prices will then substitute capital and labor away from other sectors of the economy into the energy sector. So this would be in terms of capital. The price of capital could go up, as well as the price of labor, not only in the overall economy, as we're seeing with inflation, but also relative to other sectors of the economy. We could see actually more of that in the energy sector. So we're going to assume that these global supply chain constraints continue to bind for the next year or so, before beginning to attenuate gradually. Our fourth uncertainty, of course, is decarbonization. This has been an uncertainty for the region for some time. What really changed this year was that is balancing those goals of decarbonization with energy security with the Russian invasion of Ukraine. So, last year we focused on company-specific ESG goals, and in preparation for potential carbon border adjustments that were being discussed. This year, how it's really changed is of course the Russian invasion of Ukraine, which has put more emphasis, I think, on that energy security piece of it. And I know there are different perspectives out there. Some have said that, maybe this will accelerate decarbonization. Certainly in the intermediate term, that could be the case. But certainly in the short run, what we've seen is energy security, alongside two landmark pieces of legislation, the IIJA, the Infrastructure Investment and Jobs Act, which was $1.2 trillion of stimulus spending, alongside the Inflation Reduction Act, the IRA, and which was a stimulus, of course, for the energy sector. So the IIJA, some relevant spending on energy, over $7 billion for EV charging, $16.5 billion for electric grid upgrades, and $21 billion for Superfund and brownfield cleanup sites. You've got the IRA, which was $369 billion, which really went all the way across the energy supply chain. So our view is that decarbonization will challenge existing Gulf Coast manufacturing, but will also create an important opportunity for regional leadership and the development of the production of these low carbon fuels, plastics, chemicals, you name it, in order to compete globally by having a lower carbon intensity than other parts of the world. And so industrial decarbonization can also lead to a comparative advantage for the Gulf Coast, particularly if trade policies and global tariffs become tied to environmental attributes. Something that's being discussed by our own Senator Bill Cassidy right now has been a big push from him, as well as has been discussion of carbon border adjustments in the EU. And so, the IRA is likely to speed the region's industrial decarbonization. But over the forecast horizon, what we see is that decarbonization can actually create considerable regional capital investment opportunities. And David's going to talk about that in his energy manufacturing outlook. All right. And then the last thing here is, of course, the offshore leasing. This has been just a huge deal, especially here in southern Louisiana. You might go back to 2020 campaign trail. Then candidate Biden said he was going to, quote, ban new oil and gas permitting on public lands and waters. Then his executive order comes out in January of 2021 that he says he's going to, quote, pause new oil and gas leases on public lands and waters until a comprehensive review and reconsideration of leasing practices was conducted. The March Gulf of Mexico lease sale was actually canceled. In June 2021, a preliminary injunction was granted in federal court, stating that BOEM and BLM had to move forward with lease sales in the interim. In November, you had lease sale 257 was conducted, and it was conducted successfully. But then that lease sale was vacated early this year by the administration through the courts. And so this has just been a really big back and forth, and has been a point of, I think, stress to a lot of people, especially in those communities in southern Louisiana where offshore oil and gas is a huge part of that economy. So in August, of course, the Inflation Reduction Act was signed into law. While nationally, this piece of it might not have gotten as big of attention, regionally, this was really important that lease sale 257 was reinstated, and offshore leasing has been resumed and tied to offshore wind development. So we'll note that some in industry have voiced skepticism over whether this is the end of this story. But for our modeling assumptions, we're going to assume that offshore leasing has been reinstated, and then the offshore industry is going to return to a business as usual situation, responding to economics, not to these policy issues with it. And this is kind of a assumption we have from year to year, that we go with the current policy. We don't make assumptions about future policy changes. All right. So now let's talk about upstream activity. This shows oil and gas production in the United States. What's notable is that oil production is still about 8% below the pre-pandemic peak, while natural gas production is about 2% above that pre-pandemic peak. So both have rebounded, both oil and natural gas production, but natural gas has rebounded more so in terms of coming back to that pre-pandemic level. If you look globally, the U.S. share of global oil production was really growing pre-pandemic, and then once the pandemic hit, has kind of flatlined here to about 15% of global production. If you look regionally, you see an actual similar story in that oil production is still about 8% below that pre-pandemic peak, while natural gas production is almost 6% above that pre-pandemic peak. And so what we've seen is a lot of natural gas production come back online, and part of that, of course, could be due to this export pressure that's occurring with LNG export that David is going to talk about in more detail later. This is the U.S. rig count and WTI spot price, and as you can see, of course, that the spot price has increased by a lot, but the rig count has steadily increased, but I think at a slower clip than some had maybe anticipated. And when you talk with companies, what they'll tell you is that they are really focused now on profitability more so than production. And that might have been a different story than what we saw in the 2010s when the shale boom was just really moving forward. A lot of companies were really interested in learning the geology, increasing production, making sure areas were leased. Now we've really seen this evolution that companies are way more focused on the bottom line and making sure that those investors are receiving a return on their investment. And so this is the U.S. rig count and the Texas rig count. And if you kind of squint your eyes and don't look at the axes, they look very, very similar. This is the Louisiana rig count. And one of the points is that, Louisiana, of course, we still have upstream oil and gas extraction. This is still an important industry for the state, but we're a little bit less boom bust cyclical than we used to be. And I think a lot of that is because of the relative movement towards our employment base is really more focused now on that offshore oil and gas production, as well as the Haynesville Shale, which are two, I think, more longer term, more stable, employment bases than I think the historical boom bust cycle that we've seen in this industry. And you can see that the Permian, of course, had the largest reduction in rig count during the pandemic, but has also been the largest increase since. And so really, when we're looking at U.S. production and what's moving forward, the Permian rig count is really the thing that if there's just one indicator you could look at is one that we look at, okay? And the Haynesville, of course, is doing really well, has continued to increase production. So what's happened to futures markets? These are the last 3 years GCEOs. And as I mentioned, it's kind of interesting that, yes, there was upward pressure on prices this last year for all the reasons we talked about. But in the long run, futures markets think, again, that oil is going to go back to that, $55, $60 a barrel range. It's a very different story for natural gas production that has really been increased since last year's forecast permanently. And again, a lot of that is due to the tie in with our international markets to U.S. markets, which has been facilitated by the export of natural gas via LNG. We, of course, also have the broadcast model, which is going to be the basis for our future production that goes into our employment forecast. And as you can see, U.S. and Gulf Coast oil production is forecasted to increase into the future. And you can see here, these are the last 3 years what the broadcast model has forecasted. And as you can see, with higher prices this last year, the production forecast has been upgraded. So the Gulf Coast by the mid-2030s will be producing, according to the Enverus broadcast model, something in the range of 12 million barrels a day. Okay. Natural gas production, you see a similar story where, again, we have at least a decade of growth in natural gas production in the ground. And you can see, again, the natural gas production forecast has been upgraded from last year unsurprisingly, given the commodity prices that we've seen. And all that comes together into our value of production forecast, which takes the futures market's prices. We multiply that by the broadcast production. We aggregate that up to the region, to the Gulf Coast region, and this is going to be the main input that we use for our employment forecasts. So I'm going to talk really quickly about midstream constraints. So we talk about oil midstream constraints in the outlook, but really the focus I want to talk about right now is natural gas. And so here you can see this is Henry Hub and the Dutch TTF, which is, of course, the European market for natural gas. And what have we seen? A complete divergence. This huge, discount of Henry Hub to European prices, of course, that is spurred in part by this Russian invasion of Ukraine and the gas shortages that have occurred there. And so what do we see is we see that these price differences are likely to extend over the next several years, which has enormous implications for the relative comparative advantage of the Gulf Coast and for those industries that use natural gas as a feedstock. And this shows JKM and TTF. What's kind of interesting is that we saw, pre the Russian invasion of Ukraine, a lot of, the logic for LNG was really to go to these Asian buyers. And what have we seen? We've seen that a lot of those shipments have been rerouted to Europe. And in order for them to reroute them to Europe, of course, the Europeans are going to have to pay a premium for that. So what we've seen is that now that TTF is really traded at a big premium to the JKM, but which has allowed them to get their inventories to where they need to be going into this heating season. I looked yesterday, I think European inventories are at 95%, which is above the 80% target that they set earlier in the year. And a lot of the pipeline capacity that for natural gas that is planned out there is really to facilitate the natural gas being transported to the Gulf Coast for LNG export. All right, with that, we're going to switch into the power sector. And so, David, we'll switch it over to you.
All right. Greg, am I on? Can y'all see the screen?
We can, yeah. If you want to hit full screen mode, that would be perfect.
There it goes. All right, so let's talk a little bit about power sector changes. What we're looking at here is generally where trends in retail electricity sales have been over the last 2 decades or so, and we've got the darker area that's rising towards the top that includes U.S. Electricity sales, Gulf Coast being at the bottom. The yellow marks are the gold trend showing on the right-hand axis the share of the Gulf Coast region to U.S. total retail sales. No real big surprise. I think we've talked about this in years past. The trends that we've seen post the 2008-2009 recession and overall retail sales and then load growth have been pretty flat. I would argue that a big part of that has to do with these massive investments in energy efficiency that you see throughout the United States, really heavily concentrated in places up where you've got big load centers like in the Mid-Atlantic region, New England, to a lesser extent, the Pacific Northwest and including the West as well. We've seen growth primarily driven by our industry and to a lesser extent some power generation in this region, which makes our shares relative to theirs go up. So we're seeing the Gulf Coast take a bigger piece of the pie when it comes to looking at overall electricity sales. And then when you're looking within the Gulf Coast overall, you really kind of see that trend pushing forward on industrial sales. So this is just a similar and comparable type overview of sales, focusing on the industrial sector alone. So industry, by and large, relatively flat throughout the United States, but obviously growing quite a bit along the Gulf Coast. And this all corresponds with the, over $100 billion that we've seen in CapEx in these areas where we've almost doubled essentially the productive capacity of many of these facilities. And with that comes a pretty significant amount of electricity demand during that time period. Some contractions as we've moved through the COVID time period, a little bit of a rebound, but we're still a little bit below where we were. And if you think about where that trajectory was moving, I don't know if you can see my cursor as I move through this, we're certainly well off from where some of those load projections were during that time period. As Greg mentioned, carbon emissions are important. We just finished doing the Louisiana greenhouse gas inventory, and there was a big section on power in there, and I won't belabor that today, but I think one of the important things is if you look throughout the Gulf Coast and you were to look at these numbers for Louisiana in particular, you've seen some pretty big improvements in terms of CO2 or greenhouse gas emissions per megawatt hour of generation, both in the region and in the United States. A lot of this, particularly in our part of the world, has been primarily through a lot of thermal improvements that we've seen in repowering projects and the retirements of older units, and to a lesser extent on fuel switching as well. As we move forward, as it should come as no big surprise to anyone, there are considerable changes in the dynamics of our fuel mix that we're seeing throughout the United States. A big percentage as well as absolute level increase in solar capacity as we move forward, somewhere around 137 gigawatts, about 44 in wind, and about 20 in natural gas. A lot of retirements continuing for coal. I think when you think about where these capacity additions are going to be, these may be in play as we move forward with the IRA and the Inflation Reduction Act. There's a continuation, as many of you know, with many of the tax expenditures and the production tax credit bills and the investment tax credits that have been in place for several years on an in and out basis. There's also a variety of other incentives for other energy transition issues that will help, I think, leverage renewable growth. So when you think about things like green ammonia and green hydrogen, while they're ostensibly tax credits, and we'll talk a little bit about those in a minute, that facilitate those investments, the IRA will allow you to essentially stack tax credits. So if you wanted to go in and take, a PTC or an ITC on a renewable piece of your project, and then turn around and take credits on, let's say, a clean hydrogen piece of that, you'll be allowed to do that as well. So I expect these numbers may change as we look into the future and as we do next year's GCEO. But for now, we're still looking at a lot of that. As most of you know, projects on paper are just that, projects on paper. And so usually rule of thumb is a 50-50 on what actually gets developed from announcements, but there's still a lot of capacity that's out there in the renewable space. There are a lot of it here in the Gulf Coast. This just drills down in a little bit more detail on where those capacity additions are coming from here, with a big piece of that in the solar arena, a little lesser extent in this area on wind, and still some opportunities for gas at the margin to back up some of this renewable generation. Looking at the interconnection queue in MISO, again, big increases that we see throughout MISO South and in particular in Louisiana too. Looking out into the next several years, next year and the next 2 years after that into 2025, big pieces of that pie in terms of regional investment, and particularly down here in the southern part of MISO South along the Gulf Coast. Switching now to energy exports as we move forward. As most of you know, this is the largest and one of the most integrated regions of the United States. PAD 3 is for petroleum refineries. We've got close to 10 million barrels a day of capacity, even though we do have some facilities that have shut down and some that are not operating right now. It's still the workhorse for the U.S. industry and for the global markets right now when it comes to looking at refined product exports. As Greg mentioned earlier, really big significant downturn that occurred in the refinery area as a consequence of COVID. And you saw those utilization rates hit record lows at around 65%, both for the United States and a little bit more significantly for this region in the PAD 3 region down here. We're rebounding. We're getting close to where we were and hovering around those averages prior to COVID, which is a good thing. And a lot of that utilization and production is going to serve many of these European markets that Greg talked about that need some of these distillates to backfill in for the lost natural gas that has been curtailed from Russian supplies. In terms of crude oil imports and exports, a little bit of a decrease overall in net imports since COVID, rebounding from that. Late in the time period of the crisis and moving through this year, we've seen some rebounding. So that's a good thing for us. Last year we were looking at big increases in net. Well, I don't want to say big increases, but a reversal in some of those trends as a consequence of COVID. Those have going back to normal, and certainly we're seeing more exports moving out as well. The big story in terms of energy exports for our part of the world has been LNG, and that's been where I think we've gotten not only a lot of domestic interest in this, but international as well. We've gotten at the center lots of calls and inquiries about what this entire geopolitical crisis means for LNG and the development in this region, and what it's going to mean not only for just capital formation here, but the changing composition and source of natural gas for Europe, and what it means for these energy transition issues. You can see these kind of really big kind of epic changes in LNG export volumes as we've moved through the last 20 years or so. Starting out relatively low during the 2000 period when we had a crisis here in North America on natural gas, then picking up in the aftermath of the last recession, when we started to see the unconventional revolution kick in, and then really over the last 4 to 5 years, an explosion, probably not a good word to use when you're talking about natural gas, but a really big increase in pickup and export volumes globally throughout the last couple of years. As Greg mentioned, this is just another representation, a big blow up of kind of where Henry Hub prices are to European prices. You see those numbers up around $70, and that really facilitates a lot of supply substitution and looking for better deals for natural gas for many European buyers. And one of the things to keep in mind is, while Greg is correct, a lot of this is mean reverting down to a lower level. That level is higher, and it stays pretty sustained for a while. When you move out into 2024, into 2026, you're still looking at natural gas prices that are well above kind of these historic trends that we saw over the last 3 to 4 to 5 years. During the pandemic alone, gas was almost at parity and made it almost entirely uneconomic to move gas from North America over into Europe. Now we're looking at a pretty sustained and different market as we move forward, and that's going to have implications for LNG project development and other things. We're not seeing a lot of new contracts as a consequence of that, and even some of these contracts that were announced recently have been pulled back on. So it's not the mad rush that you would expect to see, but as Greg mentioned earlier, it's likely we're going to get a couple of projects at the margin that might have had challenges in getting developed, but for this crisis in Europe. This is another graph that I think helps drive home these changes and where the gas is going around the world. You can look, prior to COVID, in COVID, these European shares, being significant, but not overwhelming the chart when you're thinking about where things were going in terms of Asia and other places around the world. And then this big pickup of European exports over the last couple of years. We've seen some decreases in the last several months due to the fire at Freeport that's limited about 2.3 or 4 BCF a day of capacity, but still pretty robust levels compared to historic trends. And I pulled this out when you start looking at the numbers just to get a real appreciation for how these European volumes have shifted and how that balance of trade issue between Europe and Asia has shifted pretty considerably as a consequence of this crisis that we're seeing in Europe right now. In terms of overall Gulf Coast exports to the world, again, we're looking at big pickups post-pandemic, particularly in oil and gas. Keep in mind that these are tied to dollar value. So as prices have increased, those dollar value of those exports have increased, as well as the refined products and chemicals as well. So robust growth there, at least on a dollar denominated basis, and things that are positive for our manufacturing activities here in the region. So, transitioning into that discussion, we've got about 180 billion through 2021 and 175 in announcements that are remaining. We're a little bit down relative to where we've been. Pretty good balance between the investments that we're seeing between Louisiana and Texas. That kind of continues as we move forward. When you're looking at project announcement on a foregoing basis, though, those tend to be shifted more towards Louisiana than Texas. Prior to 2022, LNG investment accounted for about 74 billion, and a lot of these other investments in petrochemicals were making up the balance. The one thing to kind of drive home in this chart that we're seeing, and I think is going to be a continued theme in future Gulf Coast energy outlooks, is this gray area here that I'm circling. Increasingly, we're starting to see and keep track of investments that are tied to what we'll call, for lack of better words, transition investments. So these are all your your new biofuel investments. These are all your new green ammonia investments. These are your carbon capture investments. These are all the things that are moving towards energy transition types of activities. And they're pretty significant. This is the first year in which we've broken these out and taken into account of them. You're looking at about 29 billion in overall energy transition investments in the region as we move out into 2030. And a big chunk of those, at least on the announced basis right now, 22.9, right at 23 billion, are going to be associated with Louisiana or Louisiana-based announcements. So this is really important. Keep in mind that this doesn't include anything related to renewable power generation, all those gigawatts of capacity that I talked about before. So when you kind of lump all that together and you think about the investments in renewables as well as these transition investments, I think this is going to be the new theme in the story that we'll be talking about for many years to come from this outlook as well as the future ones as well. So with that, I'll turn it over to Greg and let him talk about the employment impacts.
All right, thanks, David. All right, you can see my screen again. All right, so now we're going to talk about those employment forecasts. So really what we do in this section is we will model the upstream oil and gas extraction and services sectors, and then the refining and chemical manufacturing sectors. And we'll do that in both Texas and Louisiana. And we'll look historically what's happened, and then of course, do a forecast of that. The upstream forecasts are based on really two things. Number one, what is the Enverus Prodcast model, as well as the futures prices. And we'll put those into a econometric forecast. And then we'll make adjustments as are necessary for things like offshore leasing that we can chat about. I actually see there's a question in that we can address. For the refining and chemical manufacturing, we use the energy manufacturing numbers on capital projects that David puts together. And so we take those, we look at historical relationships between capital investment and job growth, and then we use that information to do that employment forecast. So let's talk first about Louisiana upstream oil and gas employment. So as you can see, if you go back to the pre-2014, 2015 price crash, Louisiana had about 50,000 workers in those two sectors. Then we, of course, had the price crash, and we bounced between 30 and 35,000, something in that. I think actually less than that, 33,000 maybe. Then we had, of course, the COVID pandemic hit. And in that recession, we lost about 8,700 jobs in that upstream oil and gas sector here in Louisiana. We've gained back about 2,500 of those jobs to date, but have not gained back all of them, as you can see. We're forecasting to gain about another 3,500 jobs between now and the second quarter of 2023. And at that point, although the forecast technically starts declining, at that point, we really, if you think of the error bands on this, we really view that as kind of a random walk at that point. So, we'll likely see an increase in employment over the next several months. We get into the second quarter of next year, we'll probably continue to see increases, and the latter part of next year, it'll probably level off. That is what the forecasts are saying. These are the last few years' forecasts, and as you can see, consistently, we've kind of said, okay, employment's probably going to pick up a little bit, but not get to those pre-pandemic peaks. And that continues. That's what occurred, and that continues to kind of be what our forecast is. Next, we look at Texas oil and gas extraction, and it looks very, very in oil and gas extraction and services. Of course, this looks very different. In Texas, you really still see this up and down, this boom and bust. You saw that in the 2000s with the natural gas price bust. Then you saw the oil price, that shot up, and production really shifted towards these oil plays. Then you saw the 2015 price crash, and again, you saw that bust. Then you saw the rebound pre-COVID, and then again the crash here. And so Texas lost during the pandemic about 83,000 jobs in these sectors. He's gained back about 44,000 of those. Similar to Louisiana, we're forecasting that they will gain about 12,200 jobs back. Again, that'll kind of peak in the second quarter of 2023. So again, we'll see some employment come back in these sectors. Although you can see here that the forecast technically declines at that point, we kind of really view that, again, thinking about the error bands as kind of a random walk at that point. And so again, in both Texas and Louisiana, we're saying, okay, high commodity prices are putting upward pressure on employment, but we're not anticipating those to reach the 2015, the pre-pandemic levels. It's kind of interesting that this is what the models are saying when we run the statistical analysis, but it's also good when that's really corroborated by exactly what the companies are telling you. I probably talked to a dozen upstream oil and gas companies, and pretty much every one of those told me, yes, we're hiring. Yes, we're trying to get new employees come in. We have a constraint on the number of employees that we can hire, number one, because of the supply chain constraints and the full employment that we talked about. But number two, what companies would repeatedly tell me is we're really focused on that bottom line. And so every new employee, every new rig that we put out there, that needs to on the margin be profitable, and it's unlikely we'll reach rig count levels that we saw before the pandemic anytime soon. And these are our Texas forecasts the last few years. One thing I want to note is that you saw during, for years, we had this downward trend in terms of the share of upstream employment that was in Louisiana. So of course, Texas had a lot more, Louisiana had declined over time. But what we've seen is a levelizing of this over time. And a lot of that, I think, is because of the less cyclical nature of Louisiana upstream employment. As you get into the more mature time period within the Haynesville Shale, really thinking about long-term export potential, as well as that offshore oil and gas production, which has way longer time horizons. This is corroborated with the Dallas Fed. They have their company outlook index, which is positive, but is kind of on this downward trend of saying, hey, we're probably going to, continue to hire a little bit, but this probably isn't going to go indefinitely in the future. Okay. This is Louisiana refining and chemical employment historically. So we saw a decade of growth, and then we saw about 2,200 jobs lost during the pandemic. We bottomed out this last year, and we're kind of coming back here. We're forecasting about 1,500 jobs gained by the end of 2023. In 2024, an additional 600 or so jobs gained. And then in 2025, about 550 jobs gained. And so that's really because of all this investment that's coming on, and also the coming back from the pandemic, which is why you see this larger gain here in 2023. And then post the end of 2023, I think that's when a lot of the jobs that were lost will have been back. And then you're really only relying on those new investments moving forward for job growth. And these are our employment forecasts the last year. As you can see, before the pandemic, no one was forecasting that the pandemic was going to occur. Then last year, companies were telling us that employment was going to come back. It turns out that we were about 5 months too early in terms of when that turn would occur. And so now you can see our new forecast for this year. All right. This is Texas refining and chemicals. You see a very similar trend. You see that decade of growth, and you see the pandemic. They lost about 5,700 jobs in these sectors during the pandemic. And we're forecasting that they'll gain about 4,300 jobs by the end of 2022, 700 in 2023, and 500 in 2024. Again, the logic being very similar to Louisiana, but of course, using those Texas CapEx numbers in order to model this as opposed to Louisiana. Okay. And here are our forecasts for the last few years. Again, you had the pandemic there. You can see for Texas, our forecast actually did really well this last year. Is coming back really in line with what was forecasted. And our forecast this year is really similar on the year out or so. Okay. So, I show this graph every year, but I think it's important. This is Louisiana upstream oil and gas extraction and services, and refining and chemical manufacturing. And the real thing to highlight here is that Louisiana, yes, we still have this oil and gas extraction. It's still a very important sector in the state, but we employ more people in those refining chemical export sectors than we do in that upstream. And this is very different than Texas, that is still more heavily leaned towards that upstream oil and gas extraction. And therefore, our economies are impacted very differently. The other thing to highlight is that when you think about those kind of indirect jobs within the industries, the refining and chemical manufacturing has about 2 of these indirect jobs for every one in the upstream oil and gas extraction and services sectors. And the reason for that, of course, is very logical. If you know people that work at these plants, there are people in engineering services, construction sectors. that go to those plants for turnarounds, or even people that don't work for the base company but show up for work at that plant every single day. And that's what we see here. And so it's really this energy manufacturing that has been the big employment growth here in Louisiana over the last decade. This shows the employment for the total of the two states, and then in upstream and refining and chemicals. And I want to highlight just two quick things here. The first is that if you look during the pandemic, Louisiana lost about 14% of its jobs, Texas about 11%. But upstream oil and gas extraction and services lost 26% and 35% respectively. So those sectors were more volatile than the economy overall, while refining and chemicals lost about 5 to 6%, which were of course less volatile than the economy overall. And when you look at the comeback, Louisiana has still only gained about 77% of its jobs back. Texas has regained all of its pandemic lost jobs back. And the upstream employment, again, has rebounded, but not to those pre-pandemic levels. Refining and chemicals in Texas has rebounded about the same clip. Louisiana has been a little bit slower to rebound. And so I think the point here is, again, that refining and chemicals is going to be a little bit more steady, a little bit slower moving employment numbers, which can impact the cyclicality of our economy here. All right, so with that, I will switch back over to David for the conclusions before moving into Q&A.
Greg, are you going to bring that slide up, or?
Oh, sure. I can definitely do that. That's a good idea. There you go.
All right. So thanks. So overall, the energy industry and energy economy here in the region continues to recover. There are some areas where we're better than we've been before. There have been situations where we're still a little bit behind, depending on where you at or in the region and what sector. But one of the things that we really are seeing in this kind of post-COVID environment is an important shifting away from kind of these more traditional investments into the ones that are looking at energy transition activity. Along the Gulf Coast, production numbers continue to grow. As Greg mentioned earlier, a little slower and a little bit more behind on the crude oil side than we have seen in natural gas. And it's clearly the case that a lot of that's being driven by, continued domestic demand, but more importantly, this new growth sector in LNG. When you think about what's pushing the demand side of the equation in gas markets today, it's really power generation, industrial loads, and LNG exports. And we're starting to see some slowing down, some kind of diminishing gains in both the power gen side and the industrial side. But these LNG growth numbers, as I showed you earlier, are pretty significant and likely to move forward on an ongoing basis. While prices are up overall on a relative basis, we're still predicting to see some mean reversion into 2025 and beyond. But, for some of these commodities, particularly for natural gas, we're going to likely see a little bit ratcheting up of kind of where that mean price is going to be as we move forward. And, it's really, as Greg mentioned before, one of the big uncertainties in the market is what's going on with this European crisis. And particularly what happens this winter, both here in the United States as well as what goes on internationally. This is a real big concern, I think, particularly domestically. This is something that's new for a lot of consumers, and it's new. I just actually got back yesterday from the National Regulatory Conference, and there's lots of regulators that are wringing their hands because these gas markets now have become much more tied and integrated with global markets than anything that they're accustomed to. And as most of you know, we're going to see considerably high electricity and natural gas bills for this winter. That's already baked in because most of these commodity purchases have been made, and it will continue to last as long as those prices are made or high. We're starting to see storage numbers kind of pick back up to that 5-year average, which is good, which is actually pull prices down a little bit. But, all bets are off if we go through this withdrawal season and we see really low numbers in North America and then bad things happen in Europe. So that's probably the biggest wild card when you start thinking about where the global energy economy is moving. Refineries continue to see uncertainty as we move around. This European crisis has also created strong demand for many of these middle distillates. We've seen a lot of that stuff move offshore and into those European markets right now. There are some regional concerns about availability here in the United States. And again, another thing that's driving home this point, I think, with American consumers, with regulators, with policymakers, that we live in a global economy and we live in a global energy economy as well. And when we see pressures in those global prices, we're going to see some of the impacts here domestically in the U.S. As well. Exports are going to be driven by Asian demand. The Asian situation looks a little better than I would say did maybe last year or so. There tends to be a lightening up of some of the rigidity in which you're seeing some of these COVID-related shutdowns that have created cyclicality in these Asian economies. But there's a lot of issues out there, ongoing systemic problems with these trade relationships that go back to the Trump administration. As Greg mentioned before, have been continued through the Biden administration. They're likely not going to go away. There's been this real big problem over the last year or so, particularly with the Russian invasion of Ukraine, on heightened national security concerns and how those may ripple into trade and other issues that I think are going to create some problems for us on a forward-going basis and the biggest problem of which is being uncertainty, right? On the power side of the business, again, continued, I think, industrial load growth, maybe at a slower clip than what we've seen in the past. As I mentioned before, some of our investments are down about 8% from where we were last year. And so that's probably going to taper off some of that growth, but we're going to still see some pretty reasonable movement on the power side with the industrial growth. A lot of investments, particularly with renewables that are going to get stimulated by the infrastructure bill and increasingly with this IRA and the tax incentives embedded in those. Capital expenditures, as I mentioned before, down a little bit, but still a lot of investment and a lot of growth opportunities on a forward-going basis. I think we're just kind of scratching the surface on what we see on these transition investments. This huge amount of money that's out there right now that can leverage clean hydrogen, hydrogen storage, energy infrastructure, renewable energy, et cetera, in this area makes that, I could see next year us doing a GCEO that's going to be dramatically different than what we've seen here as a consequence of that one. And then in terms of economy and policy overall, as most of you can appreciate, one political cycle is over, but the real big one just got shot off yesterday. This is going to continue to be a big issue. I think this will be a campaign issue as we move into the next presidential cycle. Energy environmental policies are very divisive on both sides. I think on a good news basis, particularly as it relates to fiscal discipline and expenditures, which can increase prices, it can increase real interest rates, it can increase nominal interest rates, which aren't good for capital formation. We're likely, if we get a slight, divided government in the House, I think the conventional wisdom is it may pick up just in a very moderate basis on the Republican side. We may see a tampering down of new investments that might help with some of these supply chain problems, inflationary problems, other things that I think are going to ripple into making big capital investments in the energy business. But these are going to continue to be big picture, big ticket policy topics that are not going to go away, and something that will be with us for the next year. So with that, that concludes our outlook. I'll turn it over to Greg to moderate a few questions if anybody has any. I think we've got time for maybe a few.
Yeah, we do. And we've got a few rolling in here. And so also, if you have any, you're welcome to type them now. So the first one says, very surprised you're assuming OCS leasing will go forward as it has in the past. And this is actually funny because Dave and I, we talked about this over and over again. So before the IRA was passed, we were talking about how do we model a fundamental change in offshore leasing? How do we think about what share of that employment comes from offshore? How do we think about the scale, the time frame in which that ramps down? And we were trying to construct a modeling framework for thinking about that to incorporate into the model. But then, of course, when the IRA was passed and it was tied to offshore leasing, we kind of abandoned that idea and said, we need to go with what the current, quote unquote, current policy regime is. But David, do you want to kind of opine a little bit about the discussions that we had and how this question is spot on? There's still a lot of uncertainty associated with this.
Yeah, I don't know if anybody can see the comment itself, but it goes through all these problems with the 5-year plan and it not being ready to go, some of the other issues with the administration. I would agree 100%. And again, as Greg mentioned, those were all the things that I had argued about before the IRA and going forward. And it's still probably likely. But I think from from a design question and from a modeling perspective, and Greg is right about this, we've historically had the position of taking the status quo policy as is for the baseline, which is something that the Department of Energy and EIA does as well. So for the baseline, we did that. If this report were a lot more expansive and we were doing multiple sensitivities and other things, I think that clearly would have been something that probably would have been the number one thing we probably would have toggled. But we did have a lot of discussions about that. I don't disagree, but in theory, in order to make some of these things quote unquote bipartisan in nature, there were some quid pro quos, and that's one of them relative to the legislation.
So one quick technical question, when do you predict time between leasing and spudding a well, and what time is used in the models? So that would actually come in the podcast model itself, which we've got documentation for that, but I don't actually know the exact answer to that, but we could definitely look into that for you, Tyler. Okay, so considering the saboteurs of the Nord Stream pipeline have not been caught, is there concern about the possibility of additional attacks on global oil and gas distribution infrastructure? Is there enough focus globally on beefing up security around energy distribution infrastructure? David, I'll let you tackle this one.
But yeah, I mean, there is a lot of concern going on, not just with national security issues, but I think more importantly, and this is in the GCEO, we didn't go through it in a lot of detail in today's discussion, but it is in the written version. There's billions upon billions that are being made, not only in resiliency, but reliability investments at the natural gas level, at the transmission level, at the distribution level. You're seeing it in the power sector as well. As it relates to that particular issue alone, I don't know if it's going to, again, it's going to see how that plays out over time. I don't know if that's going to move the needle or not, but it is going to kind of change the dynamics of how Europe itself winds up supplying its own energy. And it's one of many things. I mean, cyber concerns have been an issue here in North America across the value chain for some time now. So that's not a new factor to me as much as it is underscores that's always going to be an ongoing consideration that we have to think about when it comes to energy infrastructure, and could be one of those wild cards that I talked about earlier that could throw everything off balance and everything off kilter as we move through the winter months this year and through the withdrawal season. If something else bad happens over there, whether it be a terrorist activity or anything else, or like the rogue missile that popped off into Poland just a day or two ago, and what if that had hit something, or some other piece of energy infrastructure? I think that's going to be a continued problem.
So the next question, Ray asks, discuss your expectations for CCS, especially in view of parish moratoriums and kind of local issues. Again, David, I'll kick this one to you.
Yeah, I mean, that's been, I don't want to say it's been a big surprise, because when we were looking back at the feasibility study we completed about almost 2 years now for the region, that was a big aspect that we discussed, and not one that got a lot of attention from a lot of people, and that is public perception issues. And I don't think as an industry, people got a good appreciation for that and got out ahead of that. And that is going to be a problem. Do be aware that there are groups that are out there nationally that are opposed to carbon capture and storage and would like to not see those kinds of technologies move forward. And they are putting a lot of money and activity into grassroots advocacy to stop some of these programs at the local level. So if this is going to take off, it's going to take a lot of education. And that's things that LSU needs to be a part of, as well as industry, as well as government. And I would say, state government needs to kind of step up and work on this as well. As many of you know, this is a big piece of the governor's clean climate plan. And it's one where we don't meet his 2050 goals unless carbon capture is part of that process. So if we're serious about that, as well as the intermediate goals in 2025 and 2030, we're going to have to get moving on carbon capture and get moving pretty fast, and to the tunes of 15, 20 million tons a year of storage capabilities. And that requires a lot of movement quickly. So the longer that we have these local issues and can't get ahead of them, the more difficult it's going to be to get projects developed. And time is money, and time is really money now when interest rates are really high, and industry is going to get frustrated and go somewhere else. And East Texas, other places might be the place to go if we're having problems and can't get it resolved here.
All right, so the next question from Eric. What is your thought, David, on the future of offshore wind relative to offshore oil and gas activity? And, are those substitutes, or those complements? Is that going to be a way, if the industry does wind down, that is a way to replace those jobs? What's your thought?
Well, I mean, we'll see. To me, right now, there's so much continued activity and low-hanging fruit in the Mid-Atlantic, in the Northern Atlantic, and maybe to a lesser extent in other water areas like in the Great Lakes region, where and there's just a different environment for operating and developing and selling the power. There are more organized markets for the renewable attributes. When you think about making money, and that's what this is at the end of the day, you're going to make your investment and your return and the stability. That's going to probably be more in those markets. And there's still a lot more room to go in terms of development up in those areas. I think people will be interested in coming down here. We'll see what these future lease sales do. But I find it hard to believe that this is going to be this will probably be the latter area for development, not the more immediate one. So I would say in the next 5 years or so, it's probably going to be slow going. However, on a positive note, yeah, I mean, there are opportunities for service companies and companies that are making various different pieces of equipment that are used in the construction of these facilities up in those areas. And so that will help. But do be mindful that another thing that I don't think people talk about or appreciate or understand about this is there will be competition between basins, quote unquote, for offshore wind. And these projects are a little bit out of market. They're not competitive where you see most wholesale markets at right now. They have the cost characteristics have improved considerably. In order to get these projects done, you're going to have to securitize them through 20-year contracts, and somebody's got to back that up. And it's usually a big set of ratepayers in a big geographic area. And so that reduced risk and help the capital formation for that OSW investment. And, that's not something we have here in this area. And that's something that I think, as long as you continue to have that in those areas, that's where you're going to see projects go because they're less risky. The other thing to keep in mind is that the quid pro quo in many of those areas is that local content get developed in those areas. So if you look at places like New Jersey and New York and other places on the Eastern Seaboard, they're requiring a lot of that stuff to be sourced and the manufacturing activities to be developed there. So while there will be some Gulf Coast opportunities here, increasingly there'll be pressure if you want to continue to get projects financed in those areas. And in some states, like the ones that I work in, like in New Jersey, the RFP requirements have an explicit local content evaluation in it. So I don't think we can continue to rely on our know-how always being here and going up there, because it's going to have to be locally sourced for many of these projects, particularly as more and more get developed.
All right, one other question. We'll take one or two more here. Short-term takeaway on natural gas going negative due to the Freeport terminal and the disruptions there. Do you see this having intermediate term impacts, or do you view this as more of like a short run supply disruption?
I mean, for me, it's more short run for now. I mean, we'll just see how long that is. And again, what happens? Everything's on the mix. If we get another Winter Storm Uri that comes in and crashes in and undermines gas markets here domestically, and like I said before, some unexpected thing. We're hanging on tether hooks right now, I think. And will we get through this winter or not? We'll have to see. It's very, very early in the process.
All right. And then the one last question is, how does refining capacity today in the U.S. compare with the 1970s during those disruptions that occurred? Could you juxtapose those two?
Well, I mean, we've got more capacity at more concentrated facilities. So when we lose facilities here in North America, it's a much bigger deal than it was, say, back in the 70s and the 80s, when the average size of an individual refinery was a lot lower. And you had a lot more of them, particularly along the Eastern Seaboard, where many of them don't exist anymore. So when you're thinking about some of these regional constraints like bottlenecks on distillates and diesel fuel in some of those areas that don't have a lot of refinery, well, that's the price to pay of having a lot of those shut down during that time period.
Awesome. Any concluding remarks as we exit here, David?
None on this end.
All right. Well, thank you all so much. Thank you for participating today. Thank you for everyone we've spoken to. As always, please reach out to us. If you're someone who we should chat with for next year with putting out our outlook, please don't hesitate to email David and I. We will see you next year, if not before then. Take care.